So when we look at Reserve Bank of India, it is an important financial institution of India. And getting to know about this institution cannot go unnoticed. So keeping that in mind, in this video, we'll get to know about the history of RBI and how it evolved as an institution. The Reserve Bank of India was set up on the basis of the recommendations of the Hilton Young Commission. Now the first question that will come to your mind is, what is Hilton Young Commission? Well, it was a commission of inquiry appointed in 1926 by the British, mainly in Eastern and Central Africa. You see, just like India, many of the territories in Eastern and Central Africa were under the control of British Empire. These territories were underdeveloped during that time, and the British wanted to develop these territories at the same time reduce cost. Now this kind of a magic could only be pulled off by the British Empire. So anyways, that was the main objective of the Hilton Young Commission. So it is this very same commission that made recommendation to the British government of India to create a central bank. And that's how in 1927, a bill was introduced in the Central Legislative Assembly of British India. So this was the first recommendation of the Reserve Bank of India bill. But the bill was not passed due to lack of agreement among various members of the assembly. These were members nominated as well as elected directly and indirectly from the provinces of Madras, Bombay, Bengal, United Provinces, Punjab, Bihar, Odisha, Central Provinces, Assam and Burma. After 6 years in 1933, the bill was freshly introduced by a committee called White Paper on Indian Constitutional Reforms. The White Paper on Constitutional Reforms was a committee headed by John Simon, the same guy after whom Simon Commission was named. Just to give you a little more background, if you remember, there were 3 roundtable conferences held between 1930 and 32. The roundtable conferences were organized by the British government after the Indian politicians requested them. So the aim of this conference was to discuss on constitutional reforms of India and India's demand for Purna Swaraj, self-rule. So the ultimate outcome of these 3 roundtable conferences gave way to the formation of White Paper on Constitutional Reforms. So basically, White Paper on Constitutional Reforms was a committee formed by the British government to examine the Indian constitutional problems and to provide a recommendation for reform. And that's how in 1933, the White Paper on Indian Constitutional Reforms recommended the creation of a Reserve Bank. A fresh bill was introduced in the Legislative Assembly. In 1934, the year after, the bill was passed in the name of RBI Act of 1934 and received the Governor General's assent. The White Paper on Constitutional Reforms was the same committee that drafted the Government of India Bill, and that's how the Government of India Act 1935 came, right after the RBI Act. So this RBI Act 1934 included guidelines for the functioning of the bank. Then on April 1, 1935, the Reserve Bank of India started its operations. Now please do not think that before the creation of RBI, there was no bank in India. So prior to the establishment of Reserve Bank of India, the functions of central bank were done by the Imperial Bank of India, which was established in 1921. Basically, this Imperial Bank was made by merging 3 presidency banks of colonial India. So that time we had 3 presidencies, Bombay, Madras and Bengal. And all these presidencies had their respective banks. By merging these 3 banks, Imperial Bank of India was established. Now an important point to remember is, that is, the Imperial Bank of India was mainly a commercial bank, but it also served the British government to some extent. In the absence of any central banking institution in India until 1935, the Imperial Bank of India performed a number of functions which are normally carried out by a central bank. And in 1935, the Reserve Bank of India was formed, which became the Central Bank of India. And by the way, Imperial Bank of India in 1955, that is after independence, went on to become the State Bank of India. More on that later. So the RBI began its operation officially in 1935. Now an important thing that I would like to point out here is that the Reserve Bank of India commenced its operation as a commercial bank, meaning it had majority of its capital belonging to private shareholders. And I think it is very obvious because India had not gained independence during that time. And the creation of Reserve Bank was merely a constitutional reform that the British had granted through this committee called White Paper on Indian Constitutional Reforms. So it continued to operate as a privately owned bank till independence. 1947 is the year of India's independence. Before this, I want to quickly tell you about how the British transitioned its way in India. So we all know that the British first came as a trading company in the name of East India Company in 1612. From 1612 to 1757, they traded immensely and along the way created trading posts and expanded those trading posts in three presidency towns of Madras, Bombay and Calcutta. Then from 1757 to 1858, being a trading company, they started ruling by acquiring larger parts of India and collected huge amount of revenue. Basically, the British loot of India began. In 1857, after the Great Rebellion, which is also called as India's first war of independence, the company's remaining powers were transferred to the Crown, and that's how the British Raj started from 1858 to 1947. After 1858, India was directly administered by the British Crown, with laws passed in British Parliament. India was given a term, British India. The term British India was applied to the eastern region of Burma. In north and northeast, it stretched till Nepal and Tibet. In the northwest, it stretched up till Afghanistan. So this entire region was called as British India. In 1937, the British separated Burma province from British India. But the Reserve Bank continued to act as the central bank for Burma till 1947. On April 1947, the Reserve Bank stopped acting as a banker to the government of Burma. In the same year, British divided India into two independent dominions, India and Pakistan, by an act of partition. Even after the partition, the Reserve Bank served as the Central Bank of Pakistan up to June 1948. Thereafter, the Reserve Bank stopped rendering central banking services to Pakistan as well. In the very same year, that is 1948, the Government of India passed a bill called Reserve Bank Act of 1948. By passing this bill, the Indian government took over RBI from private shareholders after paying them compensation. And finally, on January 1st, 1949, RBI started working as a government-owned Central Bank of India. Basically, RBI was nationalized in 1949. Now that RBI belonged to the Government of India, the government had to pass what is called the Banking Regulation Act. So basically, this act is a legislation in India that gives RBI the power to regulate or license all banking firms in India. Meaning, let's say you and I want to open a bank. So we had to take a license and permission from the RBI. Because the idea behind this was that the banks in India had to be supervised and regulated. They have to be given some framework within which they had to perform their actions. You see, it was necessary because even banks could do wrong things, just like any private company. So the government's aim by enacting the Banking Regulation Act of 1949 was to have some sort of control over the banks in India. In 1950, the Constitution of India came into force and India became a republic country. In 1951, planning era started. You see, after independence, there were some immediate challenges in front of India, and they are millions of homeless refugees came to India after partition. Then India had 562 independent princely states. They had to be brought together to form a union. While some states happily joined India, while some did not wish to join India after independence. So overall, you see, after independence, the socio-economic condition of India was not that good, and colonialism had a major role to play in the exploitation of the Indian economy. So basically, what India desperately needed was a basic framework that would take the economy on a growth path. Keeping this in mind, India adopted an economic plan which is famously known as the 5-year plans. So basically, it's a list of national agendas that the government of India plans to achieve in a span of 5 years. This 5-year plan policy was adopted from the Soviet Union because they had implemented the first 5-year plan in the late 1920s, and Soviet Union was a communist party adopting socialist ideas. So India also followed that example and launched its first 5-year plan in 1951, immediately after independence, under socialist influence of the first Prime Minister, Jawaharlal Nehru. And if you have ever looked at the first 5-year plan, it was mainly focused in development of the primary sector, which is also the agricultural sector. Now, if the Indian government of that time focused on the agricultural sector, then obviously the central bank, which is the RBI, was also ordered to support economic plans with loans. It cannot be like the government of India is thinking something else and the RBI had some other plans. It is not like that. In 1955, RBI acquired a controlling interest in the Imperial Bank of India. The Imperial Bank of India was the oldest and the largest commercial bank of the Indian subcontinent, about which we read moments back. And the Imperial Bank of India was renamed on 30th April 1955 to the State Bank of India. During the time of 1951 to 1960, RBI was playing a special role in the development of agriculture in India. And one more thing you need to remember with this is that immediately after independence, India was running low on capital. Since it was the first 5-year plan, there were many projects for the country, but then there were very less money. So the government of India needed funds to promote the economy. For that, they had to restructure and nationalize many small and big banks and asked RBI to monitor and control these structures. So this way the RBI for the first time felt pressure for building the Indian economy. And that's how in 1960, after seeing the failure of few banks like Lakshmi Bank and Palai Central Bank, Government of India introduced a new policy called the Deposit Insurance Policy, which is basically financial stability. During 1950s, bank failure was a common phenomena. So Deposit Insurance Policy was seen as a measure to protect the depositors from the risk of loss of their savings due to bank failures. The purpose was to avoid panic and to promote greater stability. This way, the Deposit Insurance Corporation (DIC) bill was introduced in the Parliament in 1961 and was passed by the President and came into effect in 1962. You see, at the end of the day, this Deposit Insurance Policy is an insurance. So I think now you can figure out that it is also a way for the Government of India and the RBI to generate more capital. Because if you remember moments back, I told you that India was running low on capital and RBI was asked to monitor and control deposit insurance policy. So I hope you got the relevance. But then don't think that by introducing deposit insurance policy, the Government of India was duping the public. No, it was not like that. The reason we can say that is, you see, on one hand, with deposit insurance policy, more capital was coming in. And on the other hand, Government of India ensured that the credit needs of weaker section in society were met. It's basically rotation of money, taking from there and putting it here. By the end of 1967, many small and financially weak banks were merged with big banks for making the banking sector more stable. And RBI's authority grew and it became a central part in controlling and supporting the public banking sector in India. As time went by, from 1969 to 85, Government of India nationalized more and more banks. RBI introduced more policies like interest rates, cash reserve ratio, statutory liquidity ratio, and visible deposits. These policies were aimed at better economic development and to ensure sufficient liquidity with banks, and it had a huge effect on the company policy of the institutes. The banks lent money in selected sectors like agribusiness and small trade companies. During this time, RBI also opened new branches in India. The real test for RBI came in 1973 oil crisis, which resulted in increasing inflation, and the RBI with the help of its monetary policy reduced the effects. Now speaking about crisis, you will also have to consider the fact that in 1962 India fought a war with China. Then in 1965 there was a severe nationwide drought. Then in 1965 again India fought a war with Pakistan. And in 1971 with East Pakistan, also known as Bangladesh Liberation War. And in 1973 oil crisis happened as we discussed. And then in 1975 Indira Gandhi declared emergency in India. So all this while, we spoke about how the RBI came up as an institution. However, all these events that occurred in the 1960s and 70s substantially lowered India's GDP growth. So on one hand, in the 60s and 70s, the government made RBI a big player in the banking sector to build structure and steer the economy towards growth. But at the same time, on the other hand, all the events that I just described moments back during the 60s and 70s lowered India's GDP. So I hope you are able to see the contrast and imagine what this situation would have been like. By 1985, India started having balance of payments problem, meaning India was importing more than what it was exporting, and the import debt was rising. It went on till 1991. In 1991, the condition was so bad that India had no money to even support 3 weeks worth of imports. And RBI had refused any new credit, meaning it could not give any more money on credit. Foreign reserves were all-time low. India was almost at the verge of bankruptcy. Just imagine, if import was shut, that would mean cutting the supply of so many essential commodities, which is devastating to the economy. Like this, by 1991, India reached a balance of payments crisis. And you know what saved us? Gold. This actually became an emotional national issue at the time. So to meet the balance of payment crisis, the option of selling the gold was considered, because by selling the gold, India would increase its foreign reserve and pay for the imports. 20 metric tons of gold from the Government of India's account was airlifted and sold to UBS. After a few months, it was repurchased and the gold was bought by State Bank of India and returned to the Government of India. Manmohan Singh was the finance minister at that time. He introduced reforms that liberalized India's economy. He converted this crisis into an opportunity to build a new India. Now, because of this 1991 BOP crisis, that is balance of payment crisis, even the financial sector went through some reform. Before 1991, the role of RBI was to regulate the banking sector. But after 1991, financial reforms were introduced. The main purpose of these financial reforms were to reduce the role of RBI from a regulator to a facilitator. Basically, now RBI started working towards creating a roadmap in the interest of the banks. This meant that financial sector was allowed to take decisions on its own without having to consult the RBI, because the roadmap created by RBI would guide them. Because of this, private sector banks started arriving, both Indian as well as foreign. Then foreign investment limit in the banks of India was raised about 50%. Then banks were given the freedom to open branches without taking approval from the RBI. And they were given freedom to generate resources from abroad and within India without consulting the RBI. So these were some of the benefits of the 1991 financial reforms. In 1993, exchange rate became market determined. If you remember, previously RBI used to set the exchange rate. But after the financial reform of 1991, exchange rate was determined by market forces. Then in the very same year, that is in 1993, guidelines for the establishment of private sector banks were issued. Then in 1994, all the nationalized banks were allowed to tap the capital market to strengthen their capital base. That means previously all the nationalized banks were not allowed to find their own way of raising capital. After the 1991 reform, they were given the full liberty to explore the market and raise their funds. In 1994, lending rates of commercial banks were deregulated. That means banks were asked to declare their own lending rates. In the following year, 1995, banks were allowed to fix their own interest rates on domestic term deposit. So you see how slowly banks were given more and more freedom. And clearly you see that RBI's role is becoming more of a facilitator. Then as time went by, in 1999, RBI issued guidelines to banks for the issuance of debit card and smart cards to ease pressure on physical cash. So you see how modernization is coming in the banking sector? After the year 2000, the idea of National Electronic Funds Transfer, that is NEFT, was introduced. This was again RBI's idea and it officially started in November 2005. So in the year 2005, we entered into the era of online banking. And that is how RBI evolved as an institution. With time, its function and role changed while giving structure to the Indian economy. So in a nutshell, before 1991, RBI acted like a boss. And after 1991 crisis, it started acting like a mentor. If you found this video informative, let me know your thoughts in the comment section. Thanks for watching and I'll see you in the next one.